Just over a year ago, most said that it would be impossible to raise interest rates. I was strongly in the camp that not only will the Fed increase interest rates, they'll do it to the point in which they create problems in the financial system. That's where we are at today. Now I'm going to show you how devastating the effects of raising interest rates are because there's too much debt. And we're seeing that all over the place, from individuals to corporations to the nations themselves. They cannot pay back the debt. And when you encounter this, you start to have what's called a debt spiral, and everything spirals out of control. I'm going to show you some of these aspects and how that relates to you, your retirement accounts, and everything else interconnected. Let's begin by taking a look at Nouriel Roubini. A perfect storm of recession, debt, and out of control inflation is coming for the markets this year. Now, he has made a lot of claims before. He was one of the first to talk about the financial crisis, in which he was said, this guy doesn't know what he's talking about, and so on. Well, we could say whatever you want, but I think it's important just to highlight the fact that he says a recession, debt crisis, and stagflation trifecta is going to strike the US economy this year. And that does make a very good point. There's recession on the table, official recession, claiming. Debt crisis, we know that, as I just spoke of a moment ago, and stagflation, because you do not have that growth there. It's just simply not going to be there if inflation rates remain high. As a result, you need to have those interest rates remain high. So this is something that they would suggest that's a problem. Okay, we could look at it as, well, it's Nouriel Roubini. That doesn't matter. Doesn't really matter. What's important here is that we see how this actually affects the economy and the markets. Let's move on. Housing affordability hits a historic low. Not that that should surprise anybody, but here it is. You're looking at it, 2022, 21%. So this is an analysis by Redfin at the 100 biggest US metropolitan areas found a significant drop in affordable homes. A home is considered affordable if the monthly mortgage payment is no more than 30% of the country's median income. How many people in how many cities are actually experiencing that below 30? Like, it's just not gonna, it's like more like 80%. It's more like 90%. In Canada, that goes above 100%. So, and by the way, think of how you can calculate that. But this is what we are dealing with right now. All you had to do was raise interest rates a little bit. And speaking of which, mortgage rates jump back over 7% as inflation fears drive yields higher. So they were at 7.3%, somewhere around that range. And then they went to just under 6% and have now come back up. What has changed? Well, in part, they're looking at the fact that, well, maybe the Federal Reserve is going to have to increase rates higher than we initially believed. So the market prices that in immediately. The bond market takes that into account and starts to price it in. So that's what we need to understand about how mortgage rates work. It's not as if, your commercial mortgage bank is going to go and just, okay, tomorrow we're 7%. The next day we're 3%. No, it works because of the way that the bond market is fluctuating based on the expectations and the actions of that central bank, in this case, the Federal Reserve. So keep that in mind, okay? This is the chart that just shows us we're heading back up into those highs we haven't seen since 1980. We're almost heading in that direction, I should say. 30-year mortgage rate, just over 7%, depending on where you look, depends on your credit, depends on the company, all that. But here we are. And this is just a shy portion away from hitting the peak where we were just a little while ago. Mortgage applications, as a result, are down. Okay, so what does this mean? Why mortgage applications down? What is the impact of this? If there are less homes being bought, that means there's more inventory piling up, and that puts pressure on prices. You have inflation rates that are just too high. So the central bank is saying we got to increase our interest rates, in this case, the federal funds rate. So the Fed funds rate is at a level in which is a little bit too restrictive for most people, okay? They're still going to buy homes. They're still going to do this, but it's not going to be that frenzy that we had before. If they get to, let's say, 10%, and if we have this range of that 7 to 10% for an extended period of time, meaning beyond 2023, excuse me, beyond 2023, then you've got a problem that is going to really take over, because there's just going to be way too much inventory piling up, and all these individuals are not going to be able to pay out their debt and so on. So that's the kind of thing that will take time. We're not there yet. 2023, we need to see it go right through 2023, so it's an extended period. Not just a year, not just a short period where things are a little tight. It needs to be there for a little while. So we have to pay attention to the inflation numbers that come through. That could be the CPI number that the government loves to use, or it could be the PCE, what the Federal Reserve likes to use. And either way, we're looking at, and by the way, the PPI, Producer Price Index, these numbers are what overall we were going to be paying attention to know where we would be looking at for any difficulties that are coming our way. Right now, the stock market, not really caring. If you think about it, what is the stock market doing? It's just saying, all right, I'm just going to keep investing. Investors are just going to, play it cautiously. They're going to put some money here, they're going to put some money there, but they're still buying Tesla. They're still buying S&P. They're still doing it. So that really hasn't spooked the markets at all. And it's still near record highs. So what does it need? It needs an extended period where the Fed funds rate remains what they would call aggressively high. The entire Treasury market yields at least 4%, including the 30-year. This is key because it shows you that money will be flowing into this. And if it's flowing into the Treasury market, it's not going to be flowing into stocks as much. It's not going to be flowing into cash as much. Money market funds will not receive that. And so they're going to be getting, hey, I'll get 4%, sure. I'll get more than 4% if I choose the right investment. So that's what's going on here today. Now, we have another aspect to cover. China's central bank signals stable policy as economy rebounds. So important because the governor of the China Central Bank, he signaled monetary policy will largely remain stable this year, saying interest rates in the economy are appropriate. What does that mean? China is not going to cut rates. China is not going to increase rates. We're going to stay at about this level. Inflation should stay at about this level too. That's what China's saying. What about the ECB? ECB's Wunsch sees 4% rates possible if inflation stays high. So they have underlying inflationary pressures and they need to keep that down by increasing rates even further. That slows down the European economy even more so than we are at today. But they need to do that, of course, because of everything else that they're dealing with. There's a lot going on in Europe. Europe, I have said, is in the worst position globally. European Central Bank Vice President said underlying price pressures will be an important factor for future monetary policy decisions. While headline inflation could slow to below 6% from 8.5% now by mid-2023, the measure strips out volatile items like food and energy. What did they do this for? Oh, of course, we know. They have to take away the food and energy because they're volatile. And if you notice, every single article and every time you hear somebody at the central bank mention food and energy, the word volatile is put before it. Have you ever noticed that? Every single time. It's a same repeated pattern. It's a playbook that they play by. And so the reason that they got to get rid of that is because those are the things that people have to buy. If you remove food, energy, and housing from any of these inflation measures, doesn't look like there's much inflation. But you include them, and that's what everyone has to buy. Well, then it's always much worse than they say it is. Do you see how that works? It's a little game of cat and mouse that they love to play. The point here is that in Europe, people need to be able to deal with much higher levels of inflation. Are you ready for that? Most people are not. Okay, so I wanted to show you this. You look at it, it's the next aspect, which is basically talking about the future. Where are we at? Where are we going to? Amazon pauses construction of second headquarters in Virginia. This is coming at a time when, Amazon is not really growing the way it did before. They had to slow down on all their fulfillment centers. They cut back on a few employees. compared to where they were hiring in the previous few years. So of course, they're going to say, okay, let's just pause that for now. Let's not deal with this. Let's focus our energy on other things. And of course, it looks, you don't want to be expanding at a time like this. The shareholders may not like that as well. AI will not remedy all of our real estate woes. What it basically says in this article, in part, is that a lot of the functions done by real estate agents are going away because of AI, automation, robotics, all these different things. And I do believe that's a concern, not just for real estate agents, it's a lot of businesses. So why am I mentioning this? Why am I talking about this? I don't just include it just for fun to have articles. It's that for so many people, they are in jobs right now that they don't realize that their employers or their industry is trying to replace them with something that's much cheaper. And so we have to be aware of that. We have to look at this and realize, hey, if a robot can do my job in the next 5 years, 10 years, I better start thinking ahead now, because that's going to impact me. And on a different level, even if it's not impacting you directly, think about this, how you have businesses that are operating today that can largely wipe out a lot of their employees. Well, what happens to the general economy as a result of that? They start laying all these people off, and then you have a big problem because employment really goes down, unemployment goes up, they can't afford things, the jobs just aren't there, and so on. You've got an issue. That's the point. Robots are your new office security guard. Oh, so fantastic. The truth is they work 24 hours a day. I don't know how much they can do, but certainly most security guards are just not really doing much at a lot of these places. They're just kind of just there to give directions in most cases. So I guess it could do the same thing. People are over the 40-hour work week. We don't want to waste our time, they say. Well, what I do believe, I've seen many articles like this, and the point I mentioned is that as these new technologies come on board and as we enter a recession, full-blown recession where we have unemployment rising, a lot of these people are suddenly going to be more available for work. The article talks about the fact that they don't want to come into work, they don't want to show up to work, they want a 4-day work week, they want more stuff from their employer. But the truth is that when times get tough, they'll be showing up to work. They're going to be the first one there. Hey boss, how are you? Let me shine your shoes. Because they want to keep that employment. Right now, there's an abundance. They can do whatever they want. When times get tough, things change real quick. So watch that trend. And then we have this, LAPD may no longer send armed officers to these police calls, and it's just about everything. And the reason I mention this is that when you look at what's happening with the economy overall, it's degrading and it's declining. A lot of these cities are becoming very, very bad in many ways, and it is extremely worrisome just to see it on the whole. I worry about a lot of the major cities and where they are descending into, so you need to be prepared for that. You need to have your own protections in place. And that's financial, that's also geographical. You got to look out there, you got to say, hey, where am I going to be in the next few years? Am I going to be in this city? Well, that's up to you to decide, but watch it very carefully and closely because the trends are there. If you appreciated this message, then please hit that subscribe button down below each and every day. This is the channel that you got to be paying attention to because you get the latest and greatest information. Okay, I'll see you tomorrow. Take care. Bye.